Whenever a company drops its earnings report, it's never just a bunch of numbers on a page, right? It's a story. And today, we're digging into the latest chapter from IAA Financial Group. It's a story about hitting some huge goals way ahead of schedule, dealing with some unexpected turbulence, and then laying out a really ambitious plan for what's next. Okay, let's get into it.
So just in case you're not super familiar with them, IA Financial Group is a massive player in the Canadian insurance and wealth management world. I mean, these guys have been around since 1892. So yeah, they're a pretty big deal, a real cornerstone of the country's financial industry.
All right, here's our game plan. We'll start with the big picture on their remarkable year. Then we'll jump into the highlight reel to see the biggest wins. After that, we'll talk about the headwinds they ran into, how they're putting capital to work, and finally, what their 2026 outlook looks like.
So let's kick things off with that 30,000-foot view. How did IA themselves talk about their 2025 performance? Well, they certainly didn't hold back.
The president and CEO, Dennis Ricard, he came right out and called it a remarkable year. You know, when the top boss uses a word like that, it's not just corporate fluff. It's a really strong signal from the very top that they feel like they absolutely knocked it out of the park. So, what was all the fuss about? What exactly made the year so remarkable? Let's get into the nitty-gritty and roll the highlight reel. First up, core return on equity, or ROE. They hit 17.1%. Now, for investors, this is a huge one. It basically tells you how good a company is at making a profit from the money that's been invested in it. Not only is 17.1% a fantastic number, but it was their key midterm target, and they smashed it ahead of schedule. That is a massive green flag. Next up, they generated $665 million in what's known as organic capital. Think of it as the pure cash they created just from their day-to-day business operations. You know, no fancy accounting tricks, just core performance. And again, they didn't just meet their goal, they blew right past it, which tells you the engine of the company is just humming.
Okay, this one is, wow, a 31% jump in the amount of money they're managing, now totaling over $341 billion. That kind of growth doesn't happen by accident. It's a powerful sign of client trust and some serious business momentum.
And here's proof that their core business is as strong as ever. In just the last 3 months of the year, they set a new record for individual insurance sales in Canada. This shows that even as a huge, mature company, they're not just holding their ground, they're still actively growing their bread-and-butter business.
Okay, but you know how it is, no year is ever perfect. To really get the full story, you have to look at the challenges too. And in the fourth quarter, HIA definitely hit a few bumps in the road.
So there were basically 3 things that caused some trouble. They saw more people than expected letting a specific kind of term life insurance policy expire. They also got hit with some unusually high medical claims from a group of international students. And finally, their own expenses went up, which kind of makes sense. When you have such a great year, you have to pay out bigger bonuses. But here's the crucial part. What did they do about it? They didn't just hope for the best. Management jumped into action and beefed up their financial reserves to absorb these costs. Think of it like proactively patching a small hole now to make sure the ship is absolutely rock solid for the voyage into 2026.
And that brings us right to the future. They're sitting on a strong balance sheet with over $1.4 billion ready to go. So the billion-dollar question is, what's the game plan? What are they going to do with all that cash?
So before we look at their plan, we need to understand this one key financial term, accretive. It's simple, really. When an acquisition is accretive, it just means it's expected to boost the company's bottom line, to increase their earnings per share. It's about getting more profitable, not just bigger. And boom, here it is in action. Their recent major purchase of RF Capital isn't just expected to be accretive, it already is. And even better, it's performing ahead of their own expectations. That is a huge strategic win. This all fits perfectly into their very disciplined 2-part strategy. First, fuel growth by making smart acquisitions that make them more profitable. Second, give value directly back to shareholders by paying dividends and buying back company stock. It's a great, balanced approach. Reinvest for the future while rewarding your investors today.
So, where does all of this lead? Let's take a look at their forecast for the year to come. And it's pretty clear that management is feeling confident because they have set the bar really high.
I mean, just look at these numbers. After an amazing year with 17.1% core ROE, they're not just aiming for the same, they're aiming for more. And after generating $665 million in organic capital, they're now pushing for over $700 million. This is definitely not a company that's planning on coasting. They're hitting the accelerator.
The company's CFO, Eric Jobin,
He summed it up perfectly. He's basically saying that because their finances are so solid, they're in a great position to keep this profitable growth going. It's a statement that's all about projecting stability and, more importantly, confidence.
So, what's the bottom line here? You've got a company that is firing on all cylinders. They have clear momentum, a really aggressive plan, and the cash to back it up. But the market is always going to throw curveballs, right? So the big question remains, can they keep up this remarkable pace? That we will have to wait and see.